Let's get to our market panel. Lori Calvasina of RBC Capital Markets and Adam Crisafulli of Vital Knowledge. Guys, welcome. Lori, small caps outperformed today, but you say investors shouldn't get used to that?
Look, I think that small caps already have a lot of good news baked in. And if you look at valuations, they're basically back to average. If you look at positioning, we're basically back to the 3-year highs where the small cap outperformance trade has topped out in the recent past. So we're optimistic that we will get a broadening out in the market. We will see small caps do well on a relative basis, but I think that's more of a longer term call. I think for the here and now, what we're concerned about is that an environment where we're constantly debating whether or not the Fed waited too late to start cutting rates. Are we on the precipice of a recession? As long as we're having those conversations, it seems difficult to see small caps really continuing this big outperformance move. And I do worry a little bit heading in tomorrow that if we don't get the 50 basis points, that some of the recent price action in the small cap has really been driven by renewed optimism there.
Well, yeah, Adam, are we at the point where a 50 basis point Fed rate cut is priced into the major indices and more of the risk is to the downside with relatively high valuations?
Yeah, so I definitely think, it's going to be very interesting to see what they do on rates. I would just point out, though, that the funds rate will be one component of the overall decision tomorrow. It's just one avenue through which they really convey policy. So there'll be some pretty dramatic statement changes. We're going to get a fresh supplemental with new dots, an economic forecast. There'll be a press conference, obviously, along with potential balance sheet commentary. So in aggregate, I think that's going to be a very dovish decision. I think that they're justified in doing 50 basis points, just given what's happened with jobs, inflation, and given some of the recent rhetoric, including Powell at Jackson Hole and Waller's recent speech at Notre Dame. I think in the immediate term, markets are pricing in a pretty healthy and favorable decision from the Fed. But, fundamental news flow remains favorable for equities as far as resilient growth. We saw that with some of the data this morning. We're getting monetary easing, not just from the Fed, but ECB, Canada, a lot of the other major central banks except for Japan. And then corporate performance has been relatively healthy also. So long as that news flow stays in place, I think it's going to create upside pressure for stocks going forward.
So, Lori, maybe you're cautious on the small caps. We did have the Dow and the S&P both touch all-time highs earlier in the session. You've got the 10-year Treasury yield at the lowest since June of 2023, the 30-year lowest since July of 2023 right now. How do you position yourself not only ahead of the Fed and whatever cut we get tomorrow, but as we look to the elections and we look beyond and you do think about valuations and what's been volatility not only in equities but in bonds?
So I think there are so many moving parts right now, Morgan. And I would say, I've had some questions on what do we buy if the Fed cuts 50? What do we buy if they cut 25? I don't think there are any sort of clear sector calls on what you want to do there. I do think what we want to do is continue to look at things like valuations and sectors that can benefit from the preservation of a soft landing and the idea of interest rates coming down just a little bit. And so we keep coming back to the financial sector. And this is one that's, starting to get back to average on an absolute PE, so just PE relative to history, but it still looks pretty cheap versus the market, and we're getting good earnings revision trends there. If you talk to our large cap banks analyst, Gerard Cassidy, one thing he's been saying for quite some time is that if we were to get some cuts from the Fed and preserve that soft landing, it's really the sweet spot for the banks. And, really keeping interest rates a bit above where they've been in the past is also good for the banks. So I think that, we are looking at sectors like that, not really trying to play these short-term trades, but where do we think we want to be given where we think the economy is headed in that lower rate environment?
And, of course, Adam, it's not just the Fed with the decision this week. We have a whole flurry of central banks over the next couple of days, many of them G20 members. I mean, you've got Brazil, which could potentially tighten for the first time in 3.5 years, Bank of England rate decision on Thursday, and then perhaps just as importantly as the FOMC, the Bank of Japan, where we know there's been a lot of volatility in FX because of some of the dynamics that are going on in that part of the world right now.
No, absolutely. So the BOJ is Thursday night. Unlikely they cut at this meeting, but they've been pretty clear that they are very likely to continue bringing up their policy rate if economic data comes in as expected. So I suspect that will be the messaging that we'll hear from them Thursday night. As the BOJ was responsible or played a role in some of the volatility we saw over the summer. But I think markets have gotten their arms around that. You've seen an unwind of a lot of the yen carry trades, so that's not as large a risk as it was before. But certainly that's going to be, a major event right after the Fed, about 24 hours later or so.